Hi, Alman Glenn. I currently serve as the treasurer of the board here. This is my second term, and in light of some of the videos on the YouTube that came out, wanted to make a video of my own, post it to the AGHOA YouTube page and wherever else to clarify and give everybody a sort of preview for tomorrow's meeting. So great. So let's look first at the budget for 2024. The 2024 budget here is a document that was printed and provided to everybody in the community in November of last year. So using this sort of template, I'll walk you through the 2023 numbers to take a look at how each side of the community has a net income that's determined for it. Being a single family homeowner dollar is traced from the point of contribution through either the point of expenditure or contribution to the reserves. And similarly for a townhome owner. So here is a document with 2023 actuals, basically in the same layout and format as the 2024 budget. Now the budget has been presented in a number of different ways in this document here, in collaboration with conversation among the board members to get the budget into a more user-friendly version. So here is kind of the starting point or the template for the information on the subsequent tabs. But as you can see, the single family home owner in total, single family home side of the community made just under 10 grand in net income last year, and the townhomes had a total savings of about 46 grand in 2023 after all was said and done. So this is the same information, right? Here, just on a different presentation. So the information here, and we'll get to a point of walking through this. Of course, you can always pause the video and look through it yourself. But basically, we have the expenses down here. These are the same expenses from the first tab, and the other income matches the first tab. And then the single family home and townhome assessment income. And basically what we see here is we take the revenue of the community and the expenses of the community. We divide the expenses to get a townhome specific cost and a townhome contribution to the general fund, and offset by a little bit of benefit of net income. And then we take the single family home assessment income and subtract out the single family home cost, and we get the single family home net income. We get the townhome assessment income, which is really revenue. Subtract out the townhome operating cost and get a townhome net income. And the reason I'm kind of breezing through this is because I want to kind of set the stage for really the presentation of the document that builds on Rob's video that he made the other day on the iPad, drawing the numbers kind of from the ground up. So this is the presentation that is going to be sort of easiest to digest for the majority of people. But then why start at way one and way two tabs here, and that's really all, because this tab here is totally formula reference and cell reference back to the other tabs. This tab, you can tell it doesn't have account numbers on it, so it doesn't really have a basis in accounting, at least presented on this tab. So we have to start at the the totality of the community information, and raw accounting data or raw financial data is not very user friendly. So kind of from here we take it, we clean it, we present it in a way that's more digestible. um but so yeah, so now we have a tab. So I'll walk through this tab in a lot more detail. Okay. So all the expenses in the community for 2023 was $230,000. Okay. So breaking that down, townhome specific landscaping cost about 48,000. Townhome maintenance was about $10,000. Townhome dumpsters cost about 8,700, and then insurance specific to the townhome dwellings was 33,500. Um, the insurance is a broader topic that I'll touch on, but we'll keep going for now. So kind of just walking through the spreadsheet again, the single family home expenses in the community for the common landscaping, about $20,000. We'll touch on that later as well. And then shared expenses. So this is everybody in the community kind of pays for all of this. It was a total of about $110,000. So you take 110 plus 20 plus 100, and you get to the 230. $230,000. So the insurance not specific to the townhomes, the management company costs, the pool costs, shared service costs. That's pretty much your website and property taxes, things like that. And then shared use structures, so general maintenance, irrigation, and then utilities. We pay a lot to keep the lights on and the water running. That's a big cost that we really can't do much about. It's sort of baked into the overall. And so from here, we we take the townhome specific cost divided by the townhome owners and get to an annual cost per townhome owner. And then the single family home only cost divided by the number of single family homes, I get to a single family home only expense. It's very small. And then this is on an annual basis, right? $85 per year. And then the shared expenses specific to everybody, um, equal to these numbers here. We take these specific categories and divide them by 295. So then these are some formulas down here. So the annual cost to a single family homeowner is $460 per year. As of actual values from last year. Okay, the annual cost to a townhome owner is about $1,900. Um, and then you take the number of owners, kind of multiply it out. You get the expenses offset by a little bit of other income, and you have some total expenses here. And then the single family home assessment income and the townhome assessment income subtracted out each expense category. And you get the same values that we looked at in the previous tab, right? So the single family home net income is about 9.8, just under 10 grand, and the townhome net income about 46 grand. So kind of from here, where do we go from here? So the topic, the next topic is, we can look at, is this value high enough, right? Is the townhome net income enough, and is the single family home net income enough from 2023? The previous board, myself included, did not think that the single family home net income of less than 10 grand was enough buffer to prevent from posting an operating loss, and so we chose to restore dues to their previous levels, as experienced in if you remember the slide from my presentation, as experienced in 2021. So the 2024 dues as they are for the entirety of 2024, and as they'll probably be for the next several years, bar any tremendous need to increase them on the single family home side, are equal to the previous funding levels of as experienced in 2021. Going back to the spreadsheet. Here, so and then the townhome net income, the question of the 46 grand, is it enough? And if we determine that it's not enough, then either the top line needs to increase, or the sort of expenses need to decrease, or both. The way to increase the top line is obviously with the dues increase, and then the way to reduce the expenses is to practically renegotiate contracts, and cut all manners of cutting spending. Within our community, the largest expenses are, right. I mean, you can see it on the screen, but the pool, even more than the pool, is the landscaping, the management company, the utilities, and we really can't negotiate too much with the utilities. Duke Energy has the market here, so it's not like we can really reduce the utilities value too much. But what we can look at reducing is the insurance cost, specifically. So we pay a tremendous amount of insurance. Last year it was 38. This year it'll be about 45,000, and each year it just seems to increase. And so we're looking at ways to get leaner on that um, particular value, um, and therefore increase the townhome net income. So the other thing to talk about is really how this information is allocated between the single family home and the townhome, because we have AGOA Inc., right? AGOA Inc. Is responsible for paying all these costs. And as far as a record keeping perspective, our vendors bill us on one bill, and for most of our vendors, we don't ask them to split up the bill on sort of our internal allocation basis of 64 over 295, which comes out to roughly 21.7%, right, for the townhomes, and then the balance for the single family homes. So to say that another way, when Carolina Pool Management, who is our pool vendor, bills us, their bill is one bill. It's just a total number, right? It's about $1,300 a month. And so that $1,300 a month is then recorded to one account. And so that account is 66,500, and that's the pool contract account. And so then from there, the question becomes, well, why don't we have a 66,501 and a 66,502 for the single family home, the townhome? And the reason is, well, I suppose we could, but creates more back end record keeping burden on the vendor to split out the cost on their presented statements, burden on the accounting group at AMG, who keeps our books as our property manager. And frankly, if we did have the 66,501 and 66,502 as accounts, we would need to do a review of the GL detail to make sure that the amounts were allocated properly anyway. So the 66,500 having these accounts, excuse me, all the invoices hitting one account is fine, fine for how we track the expenses. And so the question becomes, sort of, how do we allocate the expenses across the community? And it's right here. We allocate the management co cost on the basis of everybody pays for it, pool costs on the basis everybody pays for it, things like that. So the ones specific to the townhomes are things that we could talk about. Of course, townhome maintenance, townhome dumpsters, and this is small dollars that we're talking about. It's less than $9,000 a year, but it's actually a point of frustration, I think, for a lot of townhome owners, because there's confusion on whether the dumpsters are being used by single family homeowners as well. And so, as you can see, this is only paid for by the townhomes and the year-end allocations. And so It's not fair for a single family homeowner to use the dumpsters that they're not paying for, but that's a different conversation. And then people drive up outside of the community and use the townhome dumpsters, and we can't charge them, and so this is an ongoing topic of conversation, and for $9,000, something that should run a little more smoothly. Townhome maintenance, clearly going straight to the townhomes, and then insurance. Insurance is a tough one. It's tricky to allocate. We have an email from the insurance person, uh, broker, who essentially has written out this paragraph. Right. Feel free to pause the video. Feel free to read the paragraph if you can discern it. And basically, the easiest way to describe how it was done is this broker estimate with a 91-9 split. I think that in the email we go back and forth between the total policy premium and a rate input, which is kind of comparing apples to oranges. What we really want to do is take the total premium and divide it out, not so much the inputs to the total premium. And so on a practical matter, there are the property coverage is 97% of the total policy premium here. So really on the basis of property coverage is close enough for the allocations. And so I'll put the insurance binder on the screen just briefly. Because this is a live recording, as I pull up the documents, just bear with me here. So great. As you can see here, this is our property coverage. So we have 15 buildings, right? That are insured, and so on this particular page of the property coverage, they're just named 1, 2, and 3, all the way through 15. Okay. And then scrolling down a little bit through our insurance coverage. We have what those building numbers correlate to, and so you're really able to see um, that 13 out of 15 of these buildings are townhomes. So, and then 2/15 are kind of shared property. So the insurance is allocated on the basis of go back to way one here. So you can kind of see the formulas up here, and the formula bar is the total insurance cost times 13/15 plus the insurance cost times 2/15 times 64 divided by 295. Right. So that's all that to say is taking the cost of insurance and saying that the townhome specific dwellings, 100% of the townhomes pay for the townhome dwellings. And exclusively the townhomes pay for the townhome dwellings. And then the 295 is the cost that's paid for by the total community for the pool and the clubhouse. We divide the pool and the clubhouse portion of the insurance to the whole community. And so, right, there are other things that we are insured for. We have general insurance as a corporation, as a C corp. We have director and officer liability insurance as we have directors and officers. But kind of going back to Paul's email, 97% of the total policy premium is the property insurance, and so the basis of dividing it into 15ths is close enough as an estimate. Um, Okay, great. So that was insurance. We got through insurance. Now let's talk about landscaping. So landscaping is a major cost to the community. In 2023, it cost us, you can just see the numbers there, almost $70,000. And so the way that we allocate this is very important. Right now we have a email from the vendor showing 65-35 between HOA and townhome costs. And so I'll bring up the contract. So this, what is this PDF we're looking at now? This is the service map for Yellowstone in the Yellowstone contract. And so basically the way that the cost is determined on the 65-35 split is taking a look at what is specifically a townhome cost, and that is geographically separated from the single family homes. And so we can look at that, right? And that's one of the things that I expect to have some good robust discussion on tomorrow. um, is basically that the townhomes pay for 100% of what's on this side, and the single family home owner pays for 100% of what's on this side. And so I'll flash a here. If you can kind of see my thoughts visualized in this. So right now it's on the basis of the geographic separation. There are two other ways that we could allocate it: on the basis of common ownership, that's land owned in common by AGOA Inc., which is basically the patches along Kilchurn and Caprington, and all of this area here, Almond Glen Lane. That's all owned by AGOA Inc., a giant patch of grass next to the Harrisburg Road, and then some entrances in yellow around here. And so we could ask the landscaping representative, her name is Monica, to get this a little tighter on, break up the value more than just on the basis of geographic separation. But we would need to point her to what we want to consider to be an area of the community that's divided entirely by 295 versus an area of the community that's exclusively for the benefit of the town homeowner. Um, because right now there's particularly this large patch of grass that is used for the common benefit, but is only paid for by the town homeowner. And then I think previously the patches along Kilchurn and Caprington and the Almond Glen Lane entrance were paid for in common by all 295 owners. And then only the Caprington entrance was paid for only by the 64 owners. And so we townhome owners. And so this is something we'll revisit in the budget discussion tomorrow for the benefit of the community, to talk about how the landscaping expenses is allocated. Right now it's on the basis of the geographic separation. We could reallocate on the basis of the common ownership or on the shared benefit, but we would need to agree on what the shared benefit in fact is. But all that to say, right, that's a big picture. What are we doing? We're just talking about how to properly allocate effectively 60 $70,000 or so to the townhome versus the single family home. Okay. So yeah, we got there for landscaping. We got there for insurance. So let me put another document on the screen here. So this is our operating. So this is our operating budget. So the operating sort of budget portion of the meeting is over, right? So we'll talk now about the reserves and the future. So this is historical. Everything we've talked about so far is historical, actual numbers, actual values incurred, right? 2023, the books are closed. So the next portion of the rest of this video is going to be about values that are still in flux and even in the future. So necessarily kind of go into the mindset of the next portion of the video with the mindset and the understanding that the next values presented will be estimates. Okay, very good. Let's move into the reserve study. Okay, so now the reserve study is on the screen. The reserve study, reserve advisors and the qualifications of the individuals are listed in the back of this reserve study. If you flip all the way to like page 80, and they're civil engineers. They're very good. I have no doubt that they know what needs to be done and approximately when it needs to be done. I do have doubts that they know how much it's going to cost. And frankly, that's because of what we'll look at right now. So the methodology in the reserve study is explained in one of the first pages. They take an annual rate of return of 2% for the next 30 years in the 2023 study, and an annual inflation rate of 3.5% for the next 30 years. These are essentially terminal values, right? And so terminal values, a value that is set once and goes into the future. And so if you change this value, this future inflation rate by 0.5%, all the numbers in the study will change dramatically. And this 2% as well, annual rate of return, this will also change dramatically if you increase it or decrease it. So I want to compare this methodology to the other studies. Go back with me to the 2018 study, and you see it on the screen here. This they estimated an annual rate of return for 30 years to be 1.2, an annual inflation rate for the next 30 years of 1.8. Okay, and then go back to the 2014 study. This was the first year that we got the study done. They estimated an annual rate of return on 1% and a future inflation rate of 2.5% into the future forever, which is I think historical as well. So every 5 years, these terminal values change, right? And we get this study every 5 years. One of the things we've looked at doing is getting the study every 2 years to get updated values because the macro environment changes more quickly than every 5 years. And the target of building up to every 5 years is really too far spread out to make the accurate and precise dues calculations. So in 2023, right, we have these terminal values, a 2% estimated rate of return for the next 30 years and a 3.5% future inflation rate. These values are already wrong, right? They're already inaccurate. We're earning right now more than 5% on invested funds of about $800,000. And we're inflation rate, I think inflation has settled a little bit in this last year to be closer to like 3% to 3.5%. And those basis points really matter. 50 bips makes a big difference in these terminal value calculations. So I'll flash a document on the screen here. Right, so the June 2023 reserve study. This document I'm showing now is basically if you go into the heart of the reserve study to the tables where they say that values replacement values exist for each of these. These are sum total rows for the needs of the community, kind of just summarized into into the spreadsheet. So that I have here. So the value here, just to tie out like one number so you can follow with me. It says in the spreadsheet I have open, in 2025 we'll need to spend $63,000 on the townhomes. And then you go into the 2025 column of the 2023 reserve study. This is page 16, and here's the $63,000. So right, it basically took the total rows, the total expenditure for each year over the next 30 years, expected for the community, for each side, townhome side and common funding side, and summarize them here into a spreadsheet. So in addition to the terminal values, as far as the reserve study also does not agree with itself from 2018 for the overlapping years. So in 2018, right, we had for the next 30 years were the years 2019 through 2048. And so in 2023, the next 30 years are 2024 through 2053. And so the overlapping years from the 2018 study and the 2023 study are in fact the years 2024 through 2048. Okay. Basically saying that the 2018 study and the 2024, 2023 study, both had expenses that were projected for the next 30 years, and the overlap is the years 2024 through 2048. So then this red font value here on the screen is practically showing that in the next 30 years, the reserve study from 2023 does not agree to the reserve study from 2018 by a magnitude of approximately $1 million for the townhome, and a magnitude of approximately $450,000 for the common. So basically, to take a look at this, in 2018, for the next 30 years, we had a target, right? That target was $2.7 million, 1.8 million for the townhomes and 850 or so for the common fund. And we had the target was 2.7 million. That's how much money we needed 30 years from now. And then in 2023, that number increased by $1 million for the townhome, approximately, and like 450,000 for the common. So the reserve study in itself does not agree to itself. It's saying that in the year, just to take one as an example, 2030, right? Over and under 2030, it says we will need to spend $100,000 in the year 2030 on the townhomes. And then in the previous estimate, it said we will need to spend $22,000 in the year 2030 on the townhomes. And then you have to actually go into the heart of the study and say, well, what is it in the year 2030 that they think that we'll need to be doing? And they think that in the year 2030, we will need to be spending $100,000 on the asphalt pavement repairs. So basically, the logic of the reserve study right now and the way that the dues have been calculated is that okay, so we're saving up for in the year 2030, $100,000 expense on the asphalt pavement. Um, we could asphalt pavement. We can choose whether we do that or not, and when that occurs. And then in the 2018 reserve study, the estimate for the townhome for the asphalt pavement was going to cost $150,000 in the year 2028. And then, well, what happened in the 2023 reserve study was that no, it's actually going to cost $100,000 in the year 2030. So the reserve study, again, I would say approximately, it does a great job of approximately when and what needs to be done. I do not think it does a great job Granted, I'm not sure, any one of us individually in a volunteer manner could do a tremendously better job at predicting, but I do not think that they have a very solid grasp on how much it is going to cost. And this really creates the need for two things from the reserve study. We need to get this more often, potentially every 2 years. Proposal that we really haven't discussed, but it's possible. Reserve Advisors is just one firm, and maybe we could do every 2 years, get something updated from the reserve advisors. We've had the same reserve advisors for 3 studies across 10 years. Is there a need to get a different reserve study firm? That could create confusion, but it's all up for discussion. But practically, as far as the reserves go, they are an input to the decision-making process, and the calculation of the dues in a given year. And so I want to talk about next how the reserve study is basically considered in terms of the dues estimate. So, we have the 2018 study and the 2023 study, and this says for the next 24 years, these are the expenses that will need to be incurred. And so these are just theoretical values, right? Nothing has been determined on them right now. But basically what we would do is not necessarily average them, but just for the purpose of the estimate here and walking through the methodology, I'll average them. And then we take a look at, okay, over the next 24, 25 years, this is how much money we will need in the reserves. How much money do we have now? And subtract those values, and then take a look at divided by the number of years. This is the kind of real value of the net income we need each year, right? This isn't accounting for the interest increases, things like that. Rate of return. This is how much net income that we need each year for each side. This is how much net income we need in excess of what we posted last year, which I just put a rounded value of 50,000, and then we divide that by the number of homeowners and the number of months for each side, and then we get an approximation of a number. And so this number here is not the right final anything. It's totally an estimate and approximation. But this is the methodology that we would follow uh, in terms of how we consider the reserve study in the calculation of the dues in a given year. Because I think as the previous budget videos laid out very well, the dues in the given year are in part used to cover the operating expenses, and then in part used to contribute to the reserves. Okay. So that was the reserves, and that was the operating for 2023. Next, let's look briefly at the forecast for the rest of the year. We'll talk about this more in the meeting tomorrow. But this spreadsheet here is basically saying, okay, as of August 15th, this data export is from AMG through their software. They're our record keeper. Right. So I got this data as of August 15th. It's saying we're approximately 62% of the year through the year. That's number of days. Jan 1 through August 15 is 227 days. Divided by 365, we're approximately 62% through the year. So for certain expenses that you can expect to be incurred throughout the year, like electricity, water, things like that, we are basically just taking a 1 minus what we've already incurred approach for the forecast. And for other expenses like contracts, as of August the 15th, we've incurred 8 instances. So we're taking a look for the forecast that 4 more instances will be incurred. And then for other things, miscellaneous spending, there are truly estimates that are up for discussion and highlighted in yellow. Okay. So I want to highlight some of these columns. We're basically on track to excluding interest, which we posted $29,000 in interest from interest reserves this year. Um, and so excluding that because I just want the picture of the operating budget, right? Because the hope for our interest is that we'll spend it in a given year if we have to, but we shouldn't rely on the interest from our investments in order to cover the cost of the operating in a given year. And so the operating cash, excluding the interest, is we're on track to break even through the end of the year, break even cash. And so where does that fall in terms of the budget? We had some expenses that were not budgeted for, right? The landscaping improvements were not budgeted for the of 36,000. The administrative and legal are over budget, due to the amendment process that we tried to move forward. And then the income taxes were not budgeted for in last year, so those will be corrections that we make in the 2025 budget. But I think that the sentiment of the previous board, again, of which I was a member, was that a year or two of break-even cash is not the worst thing in the world to take care of the deferred maintenance needs of the community. And we really took a look at the overall cash levels and the overall needs of the deferred maintenance of the community, particularly the townhome landscaping, and it took a look at how can we address those, and that resulted in a 2024 um, of break-even cash, excluding the interest and budget unfavorability. So, the only thing to really look at here is could we have predicted that as of making the budget in the October-November range of 2023, could we have predicted the expenditures incurred in the spring of 2024 timeframe better? And I think that the answer to that is the hindsight is always 2020, but the values here tell me that we're on track through the end of the year to break even at the cash level, and also have delivered some very good improvements to the community in terms of the addressing of the deferred maintenance. So on a go forward basis, my encouragement to the community and the board, as well as this video comes to an end, is to move forward and look at the remaining portion of the year. About 4 months left in the year, and look forward to 2025 and make a discussion on how we are going to continue to address the operating needs of the community, continue to address the maintenance in the year it's needed instead of deferring it, and as well to make the contribution to the reserve account um, in a way that's approximating our needs in the future. And then lastly, and to work backwards, to allocate the expenses between the townhome owner and the single family homeowner fairly, correctly, things of that nature. So, okay, if you've made it to the end of the video, thank you so much. And, look forward to addressing any of the questions tomorrow.